The FHSA is essentially a double tax win that the TFSA and RRSP simply cannot match for a first-time buyer. You get a tax deduction on every dollar you contribute, just like an RRSP, but you also withdraw the funds entirely tax-free, which the RRSP does not allow. To maximize this, you should prioritize filling your 8-year FHSA window before moving additional savings into a TFSA. When you use the home buyer's plan with an RRSP, you eventually have to pay that money back into your retirement account, which can create a long-term cash flow strain. The FHSA is different because it is a permanent deduction that does not need to be repaid, effectively increasing your net worth while you down the house. Always check your RRSP withdrawal limits against your FHSA contribution room to ensure you aren't double-dipping incorrectly. A TFSA is excellent for flexibility, but it lacks the immediate tax deduction that lowers your taxable income today. Because the current BOC policy rate sits at 2.25%, the tax savings from an FHSA deduction can be more valuable than the interest earned in a standard TFSA for someone in a high tax bracket. Calculate your marginal tax rate to see if the immediate deduction of an FHSA outweighs the flexibility of your TFSA. Consider the math. If you contribute $8,000 to an FHSA, you could see a significant reduction in your taxable income, potentially resulting in a larger tax refund. That refund can then be reinvested into your down payment fund, creating a compounding effect that the TFSA cannot replicate. Schedule a meeting with a tax professional to estimate exactly how much your specific FHSA contributions will reduce your annual tax bill. With the 2-year yield at 2.98% and the 10-year yield at 3.69%, the cost of borrowing remains a major factor in your home buying timeline. Using an FHSA allows you to build a larger down payment faster through tax savings, which can help you secure a better mortgage rate by avoiding mortgage insurance. Focus on maximizing your FHSA contributions every year to reach that higher down payment threshold more quickly. A common mistake is treating the FHSA like a standard savings account and forgetting about the contribution limits. If you overcontribute, you risk penalties, so you must track your annual $8,000 limit carefully. Keep a dedicated spreadsheet to log every FHSA contribution to ensure you stay within the lifetime limit of $40,000. The most effective sequence for a Canadian buyer is to utilize the FHSA first to capture the tax deduction, then use the TFSA for any excess funds. This hierarchy ensures your money is working hardest to combat rising housing costs. Set up an automatic transfer to your FHSA on every payday to ensure you hit that $80,000 lifetime ceiling without thinking about it. The FHSA is your most powerful tool in the Canadian real estate market because it combines the best features of both the TFSA and the RRSP. It is a specialized vehicle designed to get you into a home faster by making the government subsidize your down payment through tax breaks. Subscribe to get these technical deep dives to stay ahead of the Canadian economy.